So you're in an investment that's controlled by the advisor. You're sitting in this investment, which you cannot alter or even look at what their underwriting practices are, what's their future goals. You can get as much information as possible, but not enough. So really you're taking slight risk in regards to will you make that return or not? Whereas the MIC itself, it's going into an asset-backed security. The asset is a mortgage. So when you look at what your returns are, the returns are from the borrowers borrowing that money on the contract, and it goes right back into your return and on a monthly basis as well. So there is the compounding return. There's less risk than going into mutual funds and stocks individually. If you do want to look at that, I think you're kind of turning a blind eye. So if you go into mutual funds or stocks, you're kind of just hoping. Whereas an asset-backed security, like I said, just above this GIC situation, you know you're going to have a stable return. Now, don't get me wrong, mutual funds, yeah, they can blow up. They can really bust out. Stocks can bust out even more, right? I mean, I have a stock right now. It's for medical research. I really have no idea what the return will be, but it's more of a gamble. I mean, I could have taken my $250 instead of buying that stock and go down to Casino Windsor and maybe play everything on red, roulette,
roulette.
throw everything on red. So I can do that, or I can look at going, okay, what are we going into with my money? So take the 250, maybe put it in the MIC. These assets are being mitigated. The risk is being mitigated. We're lending out on an actual property where a borrower is paying funds into it, and I'm going to get a monthly statement. I don't know why anybody wouldn't want to go into this MIC. That's the biggest difference there.